Hello everyone, welcome to lecture number 6, question number 6 of company final accounts. Now this is a very lengthy question, but it covers almost every kind of adjustment and disclosure what we have studied so far. So you can mark it as important question before your exams, because what you can do is just before your exams solve this question 6, so majority points of your questions will be covered in a single question. Understand the things now, let us do the markings. Following trial balance is extracted from the books of Galaxy Limited as at 31st March 2020. Stock on 1st April 2019 will come in change in inventories. Purchases will come in direct purchases D. Building at cost tangible fixed assets. Plant and machinery tangible fixed assets. At cost means you'll see on the credit side provision for depreciation is also given therefore. Okay, therefore it's at cost. When we subtract all the accumulated depreciation of past years, what we'll get is WDV. Salaries to staff, that is employees benefit expense, interest on bank loan finance cost, printing and stationery administrative expense, trade debtors, trade receivables, investments in mutual funds, non-current investments, advertising expense, selling expense, auditors fees, administrative expense, cash on hand, cash and cash equivalents, even cash at bank, cash and cash equivalents, interest on debentures, finance cost, bills receivable, trade receivables, advance tax. Now, assessment year 2021 means previous year 1920, that is current year. For current year, we have paid tax in advance, okay, which we are supposed to pay in the next year. So that will come in short-term loans and advances, okay. I discussed with you in the earlier sessions that I discussed this with you in the earlier sessions that provision for tax, okay, provision for tax, just 1 minute, yeah, over here. Provision for tax, I discussed that current year's advance tax will be shown in, see here this one, current year's advance tax will be shown in short-term loans and advances, okay, and last year's advance tax would not have any effect, but here last year's advance tax is not given, the current year's advance tax is given because it is mentioned advance tax for assessment year 2021. Further, interim preference dividend for the half year ended 30th September 2019 will minus in statement of retained earnings, okay, mark it as minus in statement of retained earnings. Interim dividend paid will come in statement of retained earnings if it is given in trial balance. That also we have discussed earlier. DDT on interim preference dividend will also be subtracted in statement of retained earnings. Now equity share capital will come in share capital. Preference share capital will come in share capital. Profit and loss account, make it 1st April 2019, not 18, make it 2019. That will come in statement of retained earnings. Capital reserve will come in reserves in surplus. Long-term loan from not DORM, make it from FROM, from SBI, that is long-term borrowings. Provision for depreciation, again make it 1419, okay, 1419. You'll minus from tangible fixed assets, means you'll minus from building and minus from plant and machinery. 15% debentures of 100 each, that is also long-term borrowings. Sales revenue from operations, income from investment, other incomes, sale of scrap, other incomes, trade creditors, trade payables, and share forfeiture account we discussed. If it is only given in trial balance, we'll add in share capital, but if there is an adjustment which indicates that the shares are reissued, then we would show this as capital reserve in reserves and surplus. If you read adjustment 10, the equity share capital on 1st April 2017 stood at 92,000. That is 6,000 shares fully paid, so 60,000, and 4,000 shares of 80, that is 32,000, so makes it 92,000, but right now it's 1 lakh. Why is it 1 lakh? Because the directors made a call of rupees 2 per share on 1st October 2019 on these 4,000 shares, which are 8 paid up. Directors have made a call of 2 rupees on 1st October. So 4,000 also become fully paid up, that is 10 rupees. That's why in trial balance there is full 1 lakh, 10,000 shares of 10 each. Now one shareholder could not pay the final call on 400 shares and his shares were there forfeited and reissued at rupees 7 per share is fully paid up. So this means two entries have been passed, forfeiture and reissue. Profit entry has not been passed. Therefore, share forfeiture account is still appearing in trial balance. We have to pass the third entry and show it as capital reserve in reserves and surplus. So I have already discussed this in detail. You can refer to the past lectures for understanding the concept. But share forfeiture is given, and if there is an adjustment indicating reissue of shares, then you must show this amount as capital reserve in reserves and surplus. Now, you are required to prepare statement of profit and loss for the year ended 31st March 2020 and balance sheet as on that date after taking into account the following. Closing stock was valued at 1,50,000, so we will minus in change in inventories, and also we will show it as inventories itself. Okay, so put tick on opening stock, from there we have to minus it. Purchase includes 2,000 worth of goods and articles distributed among valued customers. This also we have discussed in adjustments in the lecture number 2. Okay, purchase includes 2,000 of goods and articles distributed amongst valued customers. So we will minus from purchases. Okay, because purchase should not be including it. So we'll minus from purchases and we'll add in advertising. Okay, goods are distributed to valued customers means it's an advertisement expense. In selling expense, we'll add in advertisement. So you can put tick on purchase, from there we have to minus, and you can also put tick on advertising expense, there we have to add. All this we discussed in the lecture 2 of adjustments. If you all remember, all the adjustments effects we have discussed over here. Here you can see this sixth adjustment what we discussed in earlier lecture is like that. Purchase includes worth of distributed to customers minus from purchases and plus in advertisement. Okay. So all these adjustments have already been discussed in past sessions. Salaries include 5,000 being for directors' remuneration. So we have to, salaries are salaries to staff. It should not be including it. Put tick on that. We will minus from salaries. Okay, because it should not be included in salaries. And second effect, it's a director's remuneration. So we will show it as a director's remuneration and administrative expense. In the trial balance, there is no item of director's remuneration. So second effect, we will show it in administrative expense as director's remuneration. Okay. Salaries by mistake included, so we'll minus from salaries and we'll show in director's remuneration in administrative expenses. Okay. We'll show it as director's remuneration in administrative expense. Salaries outstanding 2,000, so one effect plus in salaries. So put one more tick on salaries. Two tick means there are two adjustments. Okay. And second effect will show in other current liabilities. Provide for depreciation under reducing balance method building and plant and machinery. So minus from tangible fixed assets, and second effect depreciation and amortization. Put tick on building and plant and machinery. Then long-term loan from SBI is secured by hypothecation of building. That is a disclosure. We just have to write this information in bracket. It's a disclosure. So all of you put tick on this long-term loan from IDBI. Okay. Yeah, long-term loan from IDBI. Put tick on that. And there is a disclosure, means you can mark over here also as D. Then sundry debtors include 4,000 debts due for more than 6 months. There is also a disclosure. So in debtors you can mark it as D. D will stand for disclosure, so it will be easy to understand that you don't have to plus or minus, but just you have to write the extra information in bracket. D means disclosure. Interest on debentures for half year ended on 31st March 19, make it 31st March 20, was due on that date. Okay, all of you see here, 15% debentures of 100 each, 2 lakhs, 15% is 30,000. Okay, what is 2 lakhs into 15%? 30,000. But against 30,000, you all can see that on the debit side, interest on debentures given is only 15,000. Means remaining 15,000 is outstanding. Half year's interest of 15,000 is paid and remaining half years is outstanding. That is 15,000. What two effects we have to give for that? One effect we have to plus in interest on debentures, and second effect we have to show in other current liabilities. So here we have done it in this manner. Even if you count it for half year, see, count it. If you count it for half year, 2 lakhs into 15% into 6 by 12, then also you get 15,000. 2 lakhs into 15% into 6 by 12, also you get 15,000. Same amount you get 15,000. One effect we will plus in debentures, the other effect we will show in other current liabilities. Okay. Then authorized share capital consists of 50,000 equity shares of 10 each and 20,000 10% preference shares of 10 each, is again a disclosure. So in share capital, you can all mark it as a disclosure D. Okay. Then 10th adjustment we have already read, it indicates reissue of shares. So we discussed that share forfeiture account will get closed and we will show it as capital reserve in reserves and surplus. 1,000 10% preference shares were issued for consideration other than cash is again a disclosure. So mark one more D in share capital. There are two disclosures in share capital, authorized share capital also and shares issued for consideration other than cash also. The company has contract for, make it erection, not election, erection. Erection means construction of machinery at rupees 1 lakh, which is still incomplete. So incomplete long-term contracts are contingent liabilities. It will come in footnotes, marked as FN. Okay, contingent liabilities and commitments. Bills receivable of 3,000 maturing after 31st March 2020 were discounted is also a footnote, contingent liability and commitments. I have discussed this in lecture number 1. You can refer to lecture number 1. When I discussed contingent liabilities, I discussed other contingent liabilities, and then I made you write this example. Okay, other contingent liabilities means if bills are going to mature after 31st March 2020 and we have discounted with the bank, then what if the debtor does not pay the money on that future date? Then we will have to pay the money to the bank. So it is our contingent liability, uncertain liability. We may have to pay the money, we may not have to pay the money. We will have to pay the money only if the customer does not pay on maturity date. So it is a contingent liability, it will come in footnotes. Market value of investment, again market value of investment is a disclosure. So in investments, all of you, this investment of mutual funds, market as D disclosure. Provide for current year taxation 25.75% minus from profit before tax and short-term provisions. And directors, not directions, directors have proposed a final dividend on equity shares at 12%. So this 12% we will count on which amount? Share capital amount, that is 1 lakh rupees. Okay, 12% dividend will be counted on 1 lakh rupees, that will come to 12,000 rupees. And provide for dividend distribution tax at 20.56% for current year. This 20.56% we will count on dividend amount, which is 12,000. Okay, and both of them will come in footnote, contingent liabilities. One more thing to be kept in mind, there are preference shares also in the question. So what is the meaning of preference shares? Okay, I repeat, what is the meaning of preference shares? They have preference or priority in getting the dividend over equity shares and getting the money back when the company goes into liquidation before equity shareholders. So in this question, since preference shares are also there, okay, in this question, since preference shares are also there, you cannot propose any dividend for equity shareholders until and unless you propose it for preference shareholders. So if equity dividends adjustment is given, then there is a hidden adjustment that first you have to propose for preference shares. First you have to propose dividend on preference shares, then only can you propose dividend on equity shares, because by the nature of meaning of preference shares means as per the company law, they have priority in getting the dividend over equity shareholders. So they should be given dividend first, then only equity shareholders can be given. So here if the company or the directors are proposing dividend on equity shareholders, it is compulsory, it is imperative that directors must first propose the dividend on preference shares, then only can they propose the dividend on equity shares. Now, how much dividend on preference shares? In interim dividend, company has already given them some amount of dividend, half year's dividend, 3,000 rupees. So remaining amount is only to be proposed. Okay, means we have committed them 10% rate of dividend, 10% preference share capital is there. What is 60,000? 10%, 6,000. Half year's dividend 3,000 is already proposed. Okay, 60,000 10% dividend is 6,000. From that 3,000 is already paid and given in the half year as per trial balance. So remaining 3,000 first directors will have to propose on preference shares. 3,000 of dividend directors will have to propose remaining dividend on preference shares. DDT of 20.56% also on the same. then only can they propose the dividend on equity shares. So this will also come in footnote as a contingent liability. Okay, and we have studied also in contingent liabilities areas of dividend on cumulative preference shares. However, here they are not cumulative, but if you are giving the dividend to equity shareholders, first you are supposed to give to preference shareholders. I hope everyone is clear with this point. Directors have proposed dividend on equity shares. Since preference shares are also in the question, first you will have to propose dividend on preference shares. Okay, how will you propose dividend on preference shares? 60,000, 10% dividend is 6,000, but in half of the year interim dividend we have already paid them 3,000. Interim means half year's dividend. Out of 6,000, half year's dividend 3,000 is already paid as it is given in trial balance. So remaining 3,000, directors will first propose the dividend on preference shares. Then they will propose the dividend on equity shares, and then they will provide for dividend distribution tax on preference as well as equity. And all these things will come in footnote. I hope everyone is clear with this. All of you pause the video and make the format of P&L statement as well as balance sheet. We will be directly starting with the notes. Pause the video and make the formats. Yes, I hope everyone has done the formats. Now be attentive. First we'll start with the notes. First we'll start with the note of balance sheet. So share capital. Now in share capital, very first we have to show authorized share capital, which is given in adjustment 9. The authorized share capital consists of 50,000 equity shares of 10 each and 20,000 10% preference shares also of 10 each. Okay, so write down 50,000 and 20,000, right? Write down authorized share capital. Authorized capital 50,000 equity shares of rupees 10 each that is 5 lakhs. Then 20,000 10% preference shares of rupees 10 each that is 2 lakhs. Outer column 7 lakhs, which we will double underline. Double underline because it will not be included in the total of balance sheet. Okay, so 7 lakhs will be double underline. I hope everyone is clear with that. Then we take up with the issued, subscribed and paid up capital. Here in equity share capital, 1 lakh means 1 lakh divided by 10. There are 10,000 equity shares. And same way, 60,000 means 60,000 divided by 10. There are 6,000 preference shares. Okay, 10,000 equity shares and 6,000 preference shares. So all of you write down 10,000 equity shares of rupees 10 each. Where will you write this? Issued, subscribed and paid up capital. Issued, subscribed and paid up capital. In that we will write 10,000 equity shares of rupees 10 each, that is 1 lakh, and 6,000 10% preference shares of rupees 10 each, that is 60,000, and there will be a disclosure in bracket again. There were 2 items marked as B. Okay, so one disclosure is authorized share capital that is taken. The another one is regarding issued shares for consideration other than cash. So that is in adjustment number 11. 1,000 10% preference shares were issued for consideration other than cash. We have mentioned that in bracket. So write down of above 1,000 preference shares were issued for consideration other than cash. And final total will come to 1,60,000. Okay. Then second note will be reserves and surplus. All the items marked as RS will be taken into consideration. First we have capital reserve 25,000. Okay, capital reserve 25,000. Then we have, after capital reserve, share forfeiture account, which we have to show as capital reserve of 2,000 in reserves and surplus. Okay, capital reserve 2,000. So capital reserve itself means here itself we can add it. Do one thing. In this 25,000, show it in inner column, and capital reserve is already there, so there itself will add it. Okay, add share forfeitures balance 2,000. So total capital reserve will become 27,000. Since capital reserve is already there in the trial balance, so we don't have to show this 2,000 separately. In the same capital reserve of 25,000, we will add this share forfeiture of 2,000. So total capital reserve will become 27,000. Now here we have to leave one line for profit and loss, which we'll get from statement of retained earnings. So profit and loss balance, you will leave the space, and that we shall be getting from working note 1 later on. So keep that pending, everyone. Now third item after reserves and surpluses, long-term borrowings. All of you look at LTB marked items, long-term borrowings. In that we have long-term loan from SBI 2 lakhs, and here disclosure is also there. Okay, D is marked 2 lakhs. Long-term loan from SBI 2 lakhs. Long-term loan from SBI 2 lakhs. Now what is the disclosure given in the adjustment regarding SBI loan? Sixth adjustment, it is secured by hypothecation of building, that we have mentioned in bracket. Okay, secured by hypothecation of building. So in bracket, all of you write down secured by hypothecation. Hypothecation means mortgage. Okay, hypothecation means mortgage of building. You have secured or mortgage your building with the bank. Then after that loan from SBI, we also have debentures in long-term borrowing. Okay, long-term borrowings, this 15% debentures of 2 lakhs. 15% debentures of 2 lakhs. Total will come to 4 lakhs. Then fourth item after long-term borrowings, we don't have other non-current liabilities, we don't have long-term provisions, we don't have short-term borrowings. We directly have trade payables. Okay, so trade payables, all of you look at it. Trade creditors are there of 1,08,253. Okay, 108,253. Trade creditors 108,253, and total also 108,253. Then after trade payables, we have other current liabilities, OCL marked items. All of you see that in trial balance, OCL, other current liability, this 15,000 of interest on debentures which is outstanding. Okay, 15,000 of interest on debentures which is outstanding. So all of you write down accrued. Outstanding will write as accrued interest on debentures for 6 months means it is 15,000. Okay, how do we get this 15,000? As we have calculated above, or otherwise also you can do 2 lakhs of debentures into 15% into 6 by 12. Then also you'll get 15,000. Then after accrued interest on debentures, which is the other item marked as other current liability, in trial balance we don't have any other. In adjustments, salaries. Okay, salaries are marked as other current liabilities. Not the third adjustment, fourth adjustment. What is other current liability? 2,000 outstanding salaries. Outstanding salaries 2,000. So total other current liabilities will come to 17,000. Okay, there is no other item marked as other current liabilities. Now after other current liabilities, we have short-term provisions. In that we have provision for tax. Amount we have to keep pending because we'll be obtaining it after we make P&L statement. So liabilities are all done. Now asset side, very first is tangible fixed assets. So TFA marked items. In that first we have building of 6 lakhs. That will write in inner column as it is at cost. Depreciation is to be subtracted. So building 6 lakhs. Now credit side, provision for depreciation is given, that we will subtract first. Okay, whatever is provision for depreciation given on credit side, that we will have to subtract first. So what is the provision for depreciation on building given on credit side? 1 lakh, that we will minus first. So remaining WDV. Okay, WDV is 5 lakhs. What is that? 6 lakhs, that is the cost. And then 5 lakhs is its WDV. Then from that we'll subtract current year's depreciation. Now current year's depreciation you'll find in the adjustment. Adjustment 5. 9.5% is on buildings. Okay, so 5 lakhs 9.5%. Here we will be doing 5 lakhs into 9.5%. $47,500. If you subtract it, you will get 4,52,500. So building is done exactly same way we have to do it for, which is the other fixed asset, plant and machinery. Plant and machinery at cost is 60,000. So same way we'll do it for plant and machinery. Also write down plant and machinery at cost 60,000. Then from that we will subtract provision for depreciation that is given in trial balance on credit side. Plant and machinery's provision for depreciation 20,000. So WDV will be equal to 40,000. From that we will minus current year's depreciation, that is 40,000 into, now in plant and machinery what is the rate of depreciation given in adjustment 5? 13.91%. Okay, these are all as per company law, so percentages will find weird, but all the things are as per company law. 13.91%, that comes to 5564. Now if you subtract 40,000 minus 5564, you get 34,436. Okay, 40,000 minus 5564,34,436. So both the fixed assets are taken into consideration. Total would be 4,52,500 plus 34,436. That comes to 4,86,936. 4,86,936. Then after tangible fixed assets, we don't have intangible fixed assets. We don't have capital work in progress. We directly have non-current investments. Okay, so in non-current investments, what we have is investment in mutual funds 50,000, and there is a disclosure again in that. Okay, investments in mutual funds 50,000. Now disclosure is there. That is always the market value is disclosure in case of investment. So market value is rupees. Now how much market value is given in the adjustment? See that. Adjustment number 14. Market value is 75,000. So that will mention in bracket. Market value is rupees 75,000. Total also 50,000. Then after non-current investments, we don't have long-term loans and advances, we don't have other non-current assets, we don't have current investments, directly inventories. Okay, inventories, we have adjustment only one item, closing stock of 1,50,000. Okay, no other item of inventory is there in the trial balance. So closing stock 1,50,000. Total will also be 1,50,000. Then after inventories, trade receivables. In trial balance, trade receivables or debtors are, okay, there is a disclosure again, so 50,000. What is the disclosure? Debts. Out of 50,000, the disclosure is adjustment 7. Out of 50,000, 4,000 are due for more than 6 months. So that will show in inner column. Okay, debtors. How will we show it? Understand it. Debtors. In that we will write due for more than 6 months are 4,000. Inner column. Then other debtors. Others means remaining 50 minus 4. Remaining are 46,000. So total debtors will come to 50,000 in that manner. And that itself will be the total. So this is how we give the disclosure of debtors. Okay. How do we give the disclosure of debtors? First we write how much are debtors due for more than 6 months. Then we write the other amount, remaining amount of debtors. And then we show the total amount of debtors. Then after that 11th, after trade receivables, we have cash and cash equivalents. Two items are there always in cash and cash equivalents. Cash on hand 46389. Okay, cash on hand 46389. And then we have cash at bank 60,000. So total 1,06,389. Okay, you all can see cash at bank is 60,000. So total 1,06,389. Then after cash and cash equivalents, we have short-term loans and advances. In that we have advance tax for the assessment year 2021. Okay, advance tax given in the trial balance for the assessment year 2021, that is 20,000. So that will come in short-term loans and advances, 20,000. And that itself will be the total. Then after short-term loans and advances, other current assets we don't have. So straight away contingent liabilities and commitments. Footnote items, all of them will come over here. Let us see what all things are there in footnote FN marked adjustments. First is this 12th note, 12th adjustment, contract for erection of machinery 1 lakh, which is still incomplete. Okay, incomplete contract for erection of machinery 1 lakh. Incomplete contract for erection of machinery 1 lakh. Then what other item do we have in footnotes? Look at the adjustments. 13th, bills receivable of 3,000 maturing after 31st March 20, which were discounted. So bills discounted with the bank. Bills discounted with the bank maturing after balance sheet date, 3,000. Then what other item is there in footnote? FN is adjustment 13, 14 is done, now adjustment 16. In adjustment 16 we discuss, first we have to propose the preference dividend which is 3,000 rupees. Okay, we already discussed how did we get that 3,000 rupees. So first, preference dividend will be proposed, that is remaining 3,000 rupees. Then equity dividend will be proposed. Okay, first preference dividend will be proposed as per the nature of preference shares. Then equity dividend, as we discussed, how will you count that 12%? That 12% equity dividend you have to count on 1 lakh of equity share capital, which will come to 12,000. Okay, so equity dividend proposed 1 lakh into 12%, that will be 12,000. And then DDT we will count on both the dividends. Means what are this both the dividends? 12 plus 3, 15,000. So dividend distribution tax will be counted on 15,000. Okay, means how will you count dividend distribution tax? Basically, we count it as 15,000 into what is the rate of DDT given in adjustment, last adjustment? 20.56%. So you'll not only count on this 12,000. Okay, you'll not only count on this 12,000, but you'll also count on that 3,000 of preference dividend as well. So 15,000 is 20.56%. 15,000 into 20.56%, that is 3084. Okay, so all the footnotes have been taken into consideration, but just there is an important point in this question. If equity dividend is proposed, then first we have to propose it on preference shares, then only we can propose on equity shares. And dividend distribution tax will count on preference shares as well as equity shares. Now total of this footnotes, let us do it. Contingent liabilities total 1 lakh plus 3,000 plus 3,000 plus 12,000 plus 3084. That is 121084. 121084. Then after contingent liabilities and commitments, now we take up with profit and loss statements items, revenue from operations, RFO marked items. Only sales is there in the question. 6 lakhs. Okay, sales of 6 lakhs. And that itself will become the total. Then after revenue from operations, we'll have other incomes. Okay, next heading will be other incomes. OI marked items. What do we have in other incomes in trial balance? Income from investment 5,000. Income from investment 5,000. Then we have sale of scrap. Okay, sale of scrap. Immediately below that we have 21247. 21247. Two items of other incomes are there. Total will come to 26247. Then 16. After other incomes, we will have consumption of raw materials. We don't have, so we'll have direct purchases of stock in trade. So directly purchases are given. Okay, purchases are 2 lakh and there is a hidden adjustment in that. So we'll write in inner column. There is a tick, means there is a hidden adjustment. So purchases 2 lakhs, you'll write in inner column. Now what is the hidden adjustment regarding purchases of 2 lakhs? Adjustment number 2, we have to minus from purchases 2,000 rupees, which is wrongly recorded. Okay, it was distributed to customers, we have wrongly recorded that. So less goods distributed to customers, wrongly recorded. What amount is there? Forgot the amount. 2,000. Okay, 2,000. We have minus. So outer column 1,98,000, and that itself will become the total. Then after direct purchases of stock in trade, we'll have change in inventories. How do we find change in inventories? Opening stock minus closing stock. So what is opening stock of goods in trial balance? 1,50,000. From that we have to minus closing stock from adjustment 1. 1,50,000 itself. So it becomes 0. 1,50,000 minus 1,50,000, it will become nil. Okay, 1,50,000. From that we'll subtract 1,50,000 itself is the closing stock. So nil. Total is nil. Then after change in inventories, the next note will be employees benefit expenses. Okay, key marked items. So 18th note, employees benefit expenses. In that we have salaries to staff, and there are 2 ticks, means there are 2 adjustments related to that. So salaries to staff 50,000 you write in inner column, and there are 2 adjustments related to that. Now what are the 2 adjustments related to that, dear reader? Adjustment number 3, 5,000 we have to minus from salaries as it is for directors remuneration. So minus directors remuneration 5,000. We have wrongly included it here. So less directors remuneration 5,000. Write that in bracket, we will minus it. Then further, one more adjustment were there, 2 ticks were there. So adjustment 4. Okay, salary outstanding, we have plus in salaries 2,000 rupees. Okay, plus outstanding 2,000. Add outstanding 2,000. So 50 minus 5, 45 plus 2, 47,000, and that itself will become the total. There is no other employees benefit, so 47,000 itself will be the total. Then after employees benefit expenses, we have finance cost. In finance cost, we have interest on debenture, and there is a hidden adjustment. We will add this outstanding of 15,000. Okay, 15,000 plus 15,000, 30,000 will come. Okay, this interest on bank loan is also there in finance cost, 15,000. So all of you write down interest on bank loan 15,000. Then interest on debentures, inner column 15,000. Add accrued or outstanding 15,000. Total 30,000. And total finance cost will come to 45,000. Then after finance cost, we have depreciation and amortization. In depreciation and amortization, directly we take from tangible fixed assets note itself. So current year's depreciation is 47,500 in case of building. Depreciation on building 47,500. And second is on plant and machinery. You can see plant and machinery's depreciation in tangible fixed assets is 5564. Okay, 5564. So total will come to 47 plus 5, 52, 53. 53064. Then okay, 47,500 plus 5564, 53064. Then after depreciation and amortization, we have other expenses. In other expenses, first we have administrative expenses. Now what all items are marked as A? Administrative expenses. Printing and stationery of 24,000. Then what else is marked as A? After printing and stationery, auditor's fees of 25,000. Then after auditors fees, which other item is marked as A. In adjustments, we have third adjustment marked as administrative expense, director's remuneration of 5,000. Okay, director's remuneration 5,000. So total administrative expenses, we can do it 24 plus 25, 49 plus 5, 54,000. Then selling expenses, all the items marked as S will be taken into consideration. In that very first, we have selling expenses of advertising, and there is a tick on that, so 35,000 we will write in inner column. Advertising 35,000 in inner column. Okay, advertising 35,000 in inner column. What is the adjustment related to that? Adjustment to that plus in advertisement we have to do for that 2,000 rupees of goods distributed to customers. So we'll add over here plus goods distributed to customers 2,000, total 37,000. Then do we have any other item marked as S? No other item marked as S, neither in trial balance nor in adjustments, and there are no miscellaneous expenses also. So total of other expenses can be done from this now. 37,000 itself is total selling expenses, and total other expenses 54 plus 37, so 91,000. Okay, 54,000 plus 37,000, that is 91,000. So all adjustments and trial balance items have been taken into consideration. Now we have to do fill in the blanks. Okay, so very first we start from revenue from operations, that is 6 lakhs as per note number 14. Okay, as per note number 14, 6 lakhs. Then other incomes as per note number 15, that is 25,247. Okay, 25,247. And total will be 625,247. Cost of materials consumed we don't have, so nil. Direct purchases we have from note number 16, that is 1,98,000. Okay, direct purchases 1,98,000. Then change in inventories, we have note number 17 as nil. Okay, we got it as nil in note number 17. Then employees benefit in note number 18. So this change in inventories, we got it as nil. Employees benefit expenses, we have 47,000. Then finance cost, we have note number 19, 45,000. Then depreciation and amortization, we have note number 20. Okay, so this is 45,000. Then depreciation is 53064. 53064. Then after depreciation and amortization, we have now other expenses as per note number 21, 91,000. Okay, other expenses as per note number 21, we had got 91,000. So total of other expenses we'll have to do now. 1 lakh, so total of expenses we have to do 1,98,000 plus 47,000 plus 45,000 plus 53064 plus 91,000. That comes to 434064. 434064. Okay. Just verified once again, because any mistake then everything will go wrong. 198 plus 47 plus 45 plus 53064 plus 91,000. Yes, 434064. That we will minus from 6,25,247 total incomes. So 1,91,183 is profit before tax. Okay, 1,91,183 is profit before tax. Now, what is the provision for tax percentage? 15th adjustment. Okay, 15th adjustment. We have to provide for tax 25.75%. So 25.75% we will count on this amount of profit before tax. Okay, 191,183 into 25.75%. That comes to 49,229.6, means 49,230. Now 49,230, if you minus it, then what we will get is 141. Okay, 141,953. 141,953. So this is profit after tax. Now we will make statement of retained earnings. Okay, working note 1, we will make statement of retained earnings. After the notes, working note 1, statement of retained earnings. In that, first we will have opening balance of profit and loss account. That is, all of you see in statement of retained earnings, opening balance of P&L statement you will get from the trial balance. Opening balance of P&L account is 12,500. Okay, 12,500. In that we will add current year's profit after tax. That we got just now, current year's profit after tax, final amount 141,953. 141,953. If we add that 12,500 plus 141,953, we will get 154453. From that we will minus appropriations. In appropriations, in trial balance we have marked that interim dividend and dividend distribution tax, that we have to minus. Interim dividend of 3,000 we have to minus. Interim preference dividend, and that was preference dividend. Okay, interim preference dividend 3,000 we have to minus. Then dividend distribution tax was also there, 611. DDT 611. DDT on preference dividend 611. That also we have to minus. Any other item in adjustments, transfer to reserves, etc. we don't have. Otherwise, transfer to reserves also we would have subtracted, even then the adjustment is considered. Okay, so from this 154453 we will minus 3,000, will minus 611. What we'll get is 150842. 150842. That is balance carried forward to balance sheet. Means this we have to add in reserves and surplus. What amount? 150,842. We have to add in reserves and surplus 150,842. And total 150,842 plus 27,000. Reserves and surplus total will come to 177,842. Okay. Now we will record the things in balance sheet. So note number 1, share capital 1,60,000. Note number 1, 1,60,000 share capital. Note number 2, reserves and surplus just now as we got it, 177,842. Okay, note number 2, 177,842. Total will be 177,842 plus 1,60,000, 337,842. Then long-term borrowings from note number 3 we obtain 4 lakhs. Long-term borrowings are 4 lakhs. Then we don't have other non-current liabilities. We don't have long-term provisions, total also 4 lakhs. Then short-term borrowings, we don't have trade payables from note number 4. Trade payables are 108,253. 108,253. Then other current liabilities from note number 5, 17,000. Okay, other current liabilities from note number 5, 17,000. Then short-term provisions from note number 6. Short-term provisions from note number 6. Okay, short-term provisions we forgot to write that amount. See in profit and loss, what did we get provision for tax? 49230. So all of you write down that 49230 over there. And that itself will become the total. Okay. So 49230 are short-term provisions. All of you write down in balance sheet 49230. Now total 108,253 plus 17,000 plus 49230, that is 174483. 174483. And final total of balance sheet. Final total of balance sheet 337,842 plus 4 lakhs plus 174483, that is 912,325. 912,325. Okay, now we do with the assets side. Fixed assets we get from tangible from note number 7, 486,936. 486,936. Then intangible we don't have, so nil. Capital work in progress nil. Investments, non-current investments we have from note number 8. Okay, look at non-current investments in note number 8. We have 50,000. Non-current investments are 50,000. Long-term loans and advances we don't have nil. Other non-current assets we don't have nil. And total 486 plus 50, 536,936. Then current investments we don't have nil. Inventories we have as per note number 9. Inventories are 1,50,000. Okay, inventories from note number 9 we have 1,50,000. Trade receivables we have from note number 10, that is again 50,000. Okay, 1,50,000 and then 50,000. Then cash and cash equivalents we have from note number 11, that is 1,06,389, 106,389, 106,389. Then short-term loans and advances we have from note number 12, that is short-term loans and advances from note number 12, 20,000. Okay, short-term loans and advances are 20,000. Now total of, now all of you have to make some corrections. I'm highlighting in green in that so that you're able to identify the corrections. See, we forgot to record this bills receivable of 50,000. So do one thing, in trade receivables, every one of you insert this bills receivables of 50,000 and make the total of 1 lakh. Okay, all of you do it fast. In trade receivables, bills receivable 50,000, so total will come 1 lakh. Second mistake is in this other incomes. We had done wrong total. All of you take out other incomes. 5,000 plus 21,247 should come to 26,247. We had written 25,247. So all of you make it 26,247. Okay. Now accordingly, all of you make the corrections here. In other incomes 26,247. So total 626,247 in P&L statement incomes. Profit will therefore become 192,183 profit before tax. Now 192,183 is 25.75% will be 49487. Okay. 192,183 into 25.75% will be 49487. Profit after tax will become 142,696. Okay. I hope all of you have done this corrections. You can pause the video and do it otherwise. Then at the end, in statement of retained earnings, this profit will become 142,696. So 12,500 plus 142,696, 155,196. From that, if you subtract 3,611, you'll get 151,585 as balance carried forward to balance sheet. So make this corrections also, everyone. Pause the video and make this correction. Then in balance sheet, in the notes, reserves and surplus, make it P&L 151,585 and total 178,585. Make this correction in reserves and surplus. Okay, and next correction, make it in short-term provisions 49487. Okay, now in balance sheet, reserves and surplus 178,585, so total 338,585. Then in current liabilities, short-term provisions 49487, so total 174,740 and total 913,325. Here in trade receivables also, instead of 50,000, make it 1 lakh. Total 376,389. Now again, all of you do it. 536,936 plus 376,389. So do you all get 913,325 or not? Okay, 913,325. The balance sheet gets tallied. And then in contingent liabilities and commitments, what do we have? Note number, contingent liabilities and commitments, note number 13, 121084. Okay, 121084. So all the items have been taken into consideration. Okay. That'll be all for this lecture. Bye everyone. Take care. Re-practice this question properly. It's a very lengthy question, but a good practice before your exams.